The effects of the 2002 stock market crash today. In historical records, the year 2002 stands as a year of reckoning. The stock market crash that unfolded sent shockwaves through the global economy, leaving a trail of devastation in its wake. But what exactly happened? And more importantly, why should you care about a financial crisis that occurred over 2 decades ago? Welcome back to the channel, folks. Today we're diving deep into the 2002 stock market crash. We're going to explore what caused it, its immediate impacts, and the long-lasting effects that we're still feeling today. So let's start with a question. Tech genius in Silicon Valley, a retiree in Florida, and a factory worker in Michigan have in common? Well, in 2002, they all learned a very harsh lesson about the fragility of financial markets. But to understand their story, we need to go back in time. In the late 1990s, we saw the rise of the period called the dot-com bubble. Internet companies were the hot new thing, and investors, well, they just couldn't get enough. Companies like Pets.com, eToys, and Webvan were attracting millions in investments, despite having never turned a profit. The NASDAQ, home to many of these tech stocks, soared from under 1,000 points in 1995 to over 5,000 in March of 2000. Stock prices shot through the roof, which was based on more hype than actual profits. Price to earnings ratios, a key metric for valuing stocks, reached astronomical levels. And in March of 2000, the average PE ratio for NASDAQ stocks hit 175, compared to a historical average, wait for it, of around 15. It seemed too good to be true, and it was. By 2002, reality came knocking. The bubble didn't just deflate, it exploded. The NASDAQ, home to many of these high-flying tech stocks, plummeted by 31.5% in a single year. The S&P 500 tumbled 23.4%, and the Dow Jones wasn't far behind, dropping 16.8%. To put this in perspective, the NASDAQ fell from its peak, 5,048.62 on March 10th, 2000, to 1,114,000.11 on October the 9th, 2002. A staggering 78% drop. That's like buying a house for $500,000 and then watching its value plummet to just $110,000. But these aren't just cold, hard numbers. Behind each percentage point are real people, real jobs, and real dreams. So what happened to these people, to their jobs and their dreams? Well, let's take a journey to Silicon Valley, the heart of the tech boom. Once bustling with energy and innovation, it now resembled a ghost town. Startups had been flush with cash, suddenly couldn't keep the lights on. The San Francisco Bay Area lost 200,000 jobs between 2001 and 2004. Office vacancy rates in Silicon Valley skyrocketed from 3% in 2000 to 23% in 2002. Now, even the big players weren't safe. Cisco Systems, once a darling of the tech world, saw its value nosedive by, wait for it, 86%. Another tech giant, Sun Microsoft Systems, lost 98% of its value. These weren't just paper losses. They translated into massive layoffs and shattered dreams for thousands of tech workers. But the effects weren't confined to the tech bubble. Like a row of dominoes, the crash toppled one sector after another after another. Corporate America was shaken to its core. Companies that had used their inflated stock prices to finance ambitious expansions now found themselves in deep trouble. Layoffs became commonplace as businesses struggled to cut costs and to stay afloat. Remember Enron, once named America's most innovative company for 6 years straight? It came crashing down in a scandal that shocked the nation. At its peak in August of 2000, Enron's stock price hit $90.75. By November of 2001, it had plummeted to less than $1. The company filed for bankruptcy on December the 2nd, 2001, resulting in 4,000 employees losing their jobs and many, many more losing their life savings, which were invested, by the way, in Enron stock through their 401k plans. But the market crash didn't cause Enron's fail. It merely exposed the cracks that were already there. The company had been using complex accounting tricks to hide billions in debt and inflate its profits. The Enron scandal was just the tip of the iceberg. Another corporate giant, WorldCom, was found to have inflated its assets by $11 billion. It filed for bankruptcy in July 2002, making it the largest bankruptcy in US history at that time. Now, as the dominoes continued to fall, we came to Main Street. Imagine working your whole life and diligently saving for retirement, only to see your nest egg crumble before your eyes. Well, this was the reality for millions of Americans. 401ks shrank. College funds evaporated, and the American dream of building wealth through the stock market became an absolute nightmare. For many, this meant delaying retirement or returning to work after having already retired. But the story doesn't end there. The effects of the crash rippled far beyond America's borders. Stock markets tumbled from London to Tokyo, and the global economy, so dependent on the health of the US market, well, it began to sputter. The International Monetary Fund reported that global GDP fell from 5.2% in 2000 to 3.8% in 2002. But what if I told you that this crash, as devastating as it was, also sowed the seeds of change? That from the ashes of this economic disaster, a new, more resilient system would emerge. You see, the 2002 crash wasn't just an ending, it was also a beginning. It exposed deep-rooted problems in corporate America, leading to sweeping reforms. The Sarbanes-Oxley Act, passed in July of 2002 in the wake of Enron and WorldCom scandals, introduced stricter standards for corporate accountability and financial disclosure. The act established the Public Company Accounting Oversight Board to oversee the audits of public companies. It also required CEOs and CFOs to personally certify the accuracy of financial reports and imposed criminal penalties for knowingly filing misleading reports. Suddenly, transparency wasn't just a buzzword, it was the law. And the tech companies that survived the crash emerged stronger, leaner, and wiser. They learned valuable lessons about sustainable growth and sound business practices. Ever heard of a little company called Google? It went public in 2004, right after the crash, with a market cap of $23 billion. Today, it's one of the most valuable companies in the world, with a market cap exceeding $1.5 trillion. Amazon is another example. Its stock price fell from $107 in December of 1999 to just $5.51 in October of 2001, but the company used this period to refine its business model, focusing on operational efficiency and expanding beyond just books. By 2003, Amazon had posted its first full-year profit, and today, as we know, it's a global e-commerce giant. But perhaps the most profound change happened in the minds of ordinary investors. The crash taught hard lessons about the importance of diversification and the dangers of following the herd. Many investors who had concentrated their portfolio in tech stocks saw their wealth evaporate. This led to a renewed focus on balanced, diversified investment strategies. It's a lesson that would echo through future boom and bust cycles. Speaking of which, have you noticed any parallels between 2002 crash and more recent events? The housing bubble of 2008, the cryptocurrency craze, and the meme stock frenzy are different assets, but they share similar patterns of irrational exuberance followed by a harsh reality check. Take the 2008 financial crisis, for example. Just like the dot-com bubble, there was a belief that housing prices would continue to rise indefinitely. And when the bubble burst, again, it sent shockwaves through the global financial system, similar to the 2002 crash. Or consider the recent cryptocurrency boom. The total market capitalization of cryptocurrencies grew from about $18 billion in January of 2017 to over $800 billion by January of 2018. only to crash back down to around 130 billion by December of 2018. Sound familiar? So what's the moral of this story? Is it that the stock market is too risky? That booms always lead to busts? Not quite. The real lesson of 2002 is more nuanced and far more powerful. It's a story of resilience, of how an economy can be shaken to its core but not broken, of how failure can lead to reform, and how crisis can spark innovation. Despite the devastation of the 2002 crash, the S&P 500 had fully recovered its losses by 2007, and those who stayed invested through the crash and its aftermath were rewarded. 10,000 invested in the S&P 500 at the market's low in October of 2002 would have grown to over 50,000 by 2020. It's a reminder that change is the only constant in finance, and that understanding the past is key to navigating the future. The reforms sparked by the 2002 crash, like the Sarbanes-Oxley Act, have helped make financial markets more transparent and accountable. The lessons learned about the dangers of speculative bubbles have informed the regulatory approaches and investor behavior in subsequent years. And as we stand here today facing new challenges and opportunities, the echoes of 2002 still resonate. What lessons can we apply to today's financial landscape? How can the hard-earned wisdom of the past help us build a more sustainable, stable, equitable economic future? The 2002 stock market crash story isn't just a history lesson. It's a roadmap for the future, a cautionary tale and a source of hope all rolled into one. So the next time you check your stock portfolio or read about the latest market trends, remember the lessons of 2002. Because in the ever-changing world of finance, those who don't learn from history may just be doomed to repeat it. And who knows, the next big market event could be just around the corner. Question: will you be ready?